TheoTrade. This is Don Kaufman. December 23rd, 2022. Just about 18 minutes left inside of the trading session. Here we are going into the holiday weekend. But are we headed back into the volatility hurt locker? That, of course, is going to be the topic of conversation on this holiday weekend update. Right here, right now, heading into that weekend, S&Ps are up some 13 handles, which, well, based on this week, that's the same thing as being massively unchanged. So if you watched trade at all throughout the course of the week, it was downright wild. I mean, we had some volatility. You got to ask yourself, did this feel like a holiday week of trade? And of course not. I mean, again, markets were ripping all over the place. Hey, look, in this last maybe 2 hours, you got me. Some volatility just kind of died out a little bit, but we're still, doing decent contract size here, even on a Friday afternoon, heading into, of course, the Christmas weekend. If you zoom in here, daily volume in the S&Ps yesterday, clear up to about 1.7 million contracts today. Listen, we're well north of 1 million contracts. Just to give you, for what it's worth, typically these kind of, trading sessions leading up into a holiday weekend, be dead. You'd be lucky to do 800,000, maybe 1 million contracts. So it's also really notable. Yesterday, we saw 46 million contracts trade in options, 46 million. So the average on the year is about 41 million. That's the average for 2022. So what do? We're pacing actually heavy. Again, a lot of volatility in this marketplace. And it's one of the reasons I'm asking that question. Back to the volatility hurt locker. Well, I'm going to explain that here momentarily. Before I get too deep into that vol kind of hurt locker, one of the things that's really apparent this week, we'll cruise over to the SPX to display just this. Markets, they're going to end the week, mildly lower. And it really is just mildly lower. Like, again, people were looking for the big bad Santa Claus rally. You're not going to get it at this point. We even if you get a bump higher in this marketplace, for the most part, the market started the week very close to like 38.50. We're ending the week again just a hair lower. However, that would be in the SPX. If you take a look at over the QQQ, Q's is a very different story. Cruising to auto expected moves. Maybe you were aware, maybe you weren't aware, but the NASDAQ actually is going to close at or near the edge of the lower expected move. In effect, it's about a 1 standard deviation move, and we're actually going to close right on the edge of that 1 standard deviation move. The NASDAQ, if you take a look at the IWM, also applying auto expected moves. IWM, the Russell, is going to finish the week for the most part massively unchanged. Nevertheless, tech continued to get kind of brutalized, which we're also going to discuss here on this weekend's update. So let's kick it off with this thought, right? The volatility hurt locker. That's, by the way, that is my nickname. That's one's mine, but that's my nickname for what's termed a volatility box. If you guys have never heard the terminology of volatility box, well, let me explain it here. First of all, we're going to go ahead and close up this left side bar. I'm going to change it from a 1 minute out to a 180-day 4 hour. The reason I'm doing that is it'll really kind of emphasize, there it is, this range. And again, when I say this range, I'm going to highlight that range is from right there at 3,800 down to about 3,600. We actually jumped into that range in the September timeframe, and we literally pinged back and forth a multitude of times. I mean, many times. Eventually, that range okay, subsided and we exploded to the upside. And we exploded to the upside. There was a CPI print. There was some Fed talk, yada, yada, yada. We explode to the upside. We go to the 39.31. We explode to the upside again off the Fed, came right back to 39.31. Here we are back to 39.31, and now we're threatening to drop back into the vol box. That volatility box, just so everybody's kind of aware. And again, it's important to kind of know how long this thing lasted the last time, because it's important, you know, from a technical point of view. But it started right around September 20th, and we really didn't officially pop out of the vol box until all the way until November 9th. So you're in that for a period of almost 6 weeks, and we're right on the verge of crossing back into it, somewhere around 3,800. Again, it's rough and dirty. I actually say it's 38.11. Anything below 38.11, you really start to get trapped back in the volatility box. And that volatility box, I call it the hurt locker. And the reason I actually call it the hurt locker, people get ground up into absolutely nothing in here. You got to understand, once you're in a volatility box and you've identified as such, okay, there is no differentiation between the upper edge of the volatility box and the lower edge of the volatility box. All it is just wild, okay, chopped out, very fast trade, and you literally will ping back and forth between lows and highs in here, which you can clearly see that we did for a period of, well over a month. Nevertheless, we're just north of that once again. And that's, again, you know, I said this on the last weekend, and I said it on the Wednesday night video, and I say it again. It's an incredibly high probability at this point that we're actually sucked back into that vol box. And this next week of trade, so listen, markets are going to be closed on Monday because the Christmas holiday is falling on a Sunday. Markets are officially going to be closed on Monday. So you're going to be in a 4-day trading week. That 4-day trading week, though, again, this market just does not seem like it wants to go off into the night quietly. Like, you know, until right up into the end of December to the last moment of this year, this marketplace is just not letting us out. And it is what it is. Okay, so expect some volatility throughout the course of next week. Now, it doesn't necessarily mean like, you know, the VIX is going to rage, which I'll discuss here in a few minutes, but expect markets to continue to have some decent sized movement. There's even some data coming out throughout the course of next week. Nothing too crazy, but, you know, retail inventories, wholesale inventories. It's, you know, it's the usual suspects that are coming out. Pending home sales, again, not exactly going to be a market moving event, but I'll tell you what, there were several data points that came out this week that none of us really thought were going to move markets. They absolutely unequivocally did. This morning, as Mr. Toad's wild ride, you had durable goods. Durable goods was really bad, but at the exact same moment, the PCE indicator came out. So it was like a momentary lapse of a significant drop in the market, and everybody goes, the PCE indicator. That rallied us back up. Next thing I know, we're actually headed back lower again. There was some volatility. All of this was prior to the cash open. You have to love that, because the biggest moves today were pretty much, well, prior to the cash open. We sold back off after the cash open, rallied back, and here we are with the S&Ps, as I said. Up 16 to me means absolutely nothing. All right, let's start to get a little bit more stock specific. One of the things that has kind of taken center stage in the last couple of trading sessions, everybody is talking about Tesla till you're pretty much blue in the face. Okay, here's the deal with Tesla. Okay, it's over, it's done with. It doesn't make a difference anymore. So Tesla has gotten pummeled. Its volatility, by the way, is extreme. The volatility is just south of 100% IV. But when I say it's over and done with, it's over and done with on a market cap point of view. And I mean by that is, take a look at the market cap. We're doing about $387 billion market cap. And what's crazy about that is NVIDIA is neck and neck now with Tesla. So granted, Tesla for a period of time was actually double NVIDIA's market capitalization. They're now actually neck and neck. Obviously, NVIDIA's volatility isn't exactly as high as Tesla, but it ain't that far off. I mean, even NVIDIA is close to a 60% implied volatility, but Tesla, I mean, literally, it's just shy of 100%. So it's still extreme. Nevertheless, okay, Tesla, it can still be a drag on the NASDAQ to some degree, and has been a drag on the NASDAQ, if you will, over the last 3 weeks of trade. Actually, if you bring up auto expected moves, this is interesting, but it's got 1, 2, 3 full weeks back to back that it's been outside the lower edge of the expected move. However, at the exact same time, I'm saying it's over, it's done with, don't pay any attention. The reason I'm telling you, okay, forget Tesla for just the time being. Now you really do have to focus on Apple. Okay, I brought this up in the Wednesday night video, and I'm going to reiterate it again today. Okay, if you're not watching Apple, you're not seeing, okay, what could be a critical and lasting break lower for not just the NASDAQ, but also the S&Ps. Very clear and decisive would be Apple's market cap, which is still north. And again, I'll bring it up just for those of you that don't know this, still north of $2 trillion. The only thing that even is close to it, of course, is Microsoft. And Microsoft is about 1.75, okay, 1.77, I should say, trillion dollars. Even Google off the radar at this point, $1.1 trillion. I mean, what's $1 trillion amongst friends? But I'm just saying it doesn't even, hold a candle to what is Apple or what is, for instance, Microsoft. The reason you have to have cause for concern, we're actually going to close that up and take a look. This is a 3-year chart, 3-year daily chart in Apple. Apple loses 130. It's easily a straight shot down to 120, if not even the $100 marker at this point. It is, again, it's a very, very critical level, but another $10 drop for Apple would really, hammer the S&P. So again, kind of forget about the NASDAQ for just a second. The NASDAQ has been getting brutalized. There's no question about it. Okay, but they're going to come for the S&Ps at that point. And it is Apple and a break lower in Apple that'll push us into the volatility box. So just be aware of it. Okay, I mean, it's right on the cusp over here, just, sitting in and around that 130 handle, but hasn't fully blown through that 129.04 that we saw. That was, by the way, very close to the market lows back here on Apple. So Apple, yeah, even though it's down right now, 27% year-to-date basis. This was the stock that we had talked about this summer as being almost completely unscathed. We're like, you got to get short Apple, got to get short Apple. I'm short Apple in all kinds of different ways over here. Short the stock, I'm long out of the money put spreads, okay? And those out of the money put spreads, they're not out of money anymore. I mean, they're actually technically in the money. Nevertheless, okay, Apple is going to be the stock to watch, even in this next holiday week of trade, especially when some of the sales numbers start to come out. Of course, that'll happen as soon as you'll start hearing whispers of sales numbers and retail sales numbers next week, but goes full Monty in the beginning of January. Anyway, focus has to shift to that. With that, it's very apparent. Amazon, which Amazon has already broken to the downside, but for Amazon, you realize you have to pull up a 5-year chart to actually see how far it's gone. Amazon is not going to be a pivotal stock and pivotal player right now. It's already actually broken through the 100 level at this point. 80, which is very close to where it's presently trading, looks to be degrees of support in there to some extent. All right, we're going to shift around for a second to bonds. Okay, bonds. This week, some pretty decent sell side activity, and I just want to bring up with those bonds. If you look at TNX, which of course is the 10-year, there's a little bit of a bid back under the 10-year, meaning that the interest rates are actually going higher, as of course the bonds and notes head a little bit lower. I say this so interest rates are going back up, but I'm kind of questioning for how long. I believe that some of the data that is about to come out in the beginning of the year, some of those data points is not going to exactly be positive for the economy. And we may actually see bonds once again rally, taking interest rates lower. Why? We got to get bonds, okay, if you will, pricing in and more effectively pricing in a recession. That was actually the topic of last week's weekend update was, what are markets saying about a recession? And I got to tell you, it just doesn't feel, especially with bonds selling off like this week, the marketplace just doesn't feel like it's pricing in a recession. There's still arguments like, are we going into a recession? Most of the analysts are now arguing, is it going to be a mild recession or is it going to be a very, very hard landing? Either way you want to look at it, okay? The sell side activity here in the bonds, in my opinion, is a little unprecedented. And I'll just be very, very clear. That sell side activity inside of the bonds, as soon as some economic data starts to come out, and those data points are not good, those bonds are going to rip back to the upside. And that's exactly what I would anticipate possibly as early as this next week of trade. With that kind of transpiring, financials. All right, we got to cruise over to the financials because this is an area that has actually kind of bothered me. Look at the year-to-date, okay, gain or loss. In this case, the loss. The financials are down about 14% on a year-to-date basis. Now, the one sector it's flying high is energy. Energy's up about 52%, and you'll see trade looks like it wants to pile into energy into the end of the year because all the portfolio managers do what they have to, like dress the portfolios into the end of the year. So look, we own energy, right? But the one thing that's become very, very, I think, transparent to me at this point is if the S&Ps are going to start to head lower from where they presently are, forget about like 2022, 2023, forget about it. Just, put it in the books already. Well, not 2023 yet, but if the S&Ps are going to head lower, okay, you're absolutely unequivocally going to have participation, okay, from financials, meaning that the financials are going to have to head lower. You, of course, would have Apple breaking lower, but some of these other underlyings, including stuff like Tesla or even NVIDIA, which started to see some heavy sell side activity again, okay, they have been pummeled. So at this point, we have to play a little bit of the sector rotation game. Again, I believe that the bonds are actually going to head back higher, taking interest rates a little bit lower. As interest rates start to go lower, it starts to undermine the financials. Look for the financials in the next week or two to actually see some sell side activity. That is if the S&Ps are actually going to head a bit lower. So as I said, financials, they're going to take on some damage. If you are bearish on markets at present time, and that's important, it's an if. Like if you're bearish in the markets right now, look towards the XLF to actually take a fairly large percentage hit. All right, one of the last points I want to make here for this next week of trade is that do not look for surges in volatility. A lot of people have been looking towards the VIX, and I've kind of continually reiterated this because people are getting very frustrated. Like, come on, man, VIX is not doing anything. That means the markets are not really going lower. First of all, okay, did the markets really head lower this week? And the answer is no. I mean, it was kind of slop-tastic this week. I'm the first one to tell you, like, look at the S&Ps. The S&Ps, and again, I'm just going to zoom in, right, to where the S&Ps. The S&Ps started the week at roughly 38.52. Where are they right now? $9 lower, and we're not closed yet. So for the most part, again, the week was massively unchanged. Don't look for VIX to take off to the upside. And the reason it has nothing to do with, well, the markets are higher, the markets are lower, right? Look, volatility is lower. Holidays do play a role. And here we come into the cash close of this week. There it is. It's all over. But if you will, that volatility, it should go a little lower. Yeah, next week is, quote unquote, the holiday week of trade. But my reasoning is very simple. Okay, this, and I say this, okay, in the S&Ps, right, we're in really, really well charted territory, like about the best territory in terms of like charting territory. Okay, look at the line across the screen over here. Like everything that's transpired in this zone, okay, that's the most frequent place that we've been. The absolute most frequent place is dead in the middle, okay, of where we've been over the last 180 days. Like you shouldn't even question like, well, there's just not a lot of volatility. I shouldn't feel the fear. Listen, the markets are not going to feel the fear at all. Okay, even inside the vol box, because we were in that vol box for 6 weeks, they're not going to feel the fear. Okay, until they got down in and around 3,600. And quite frankly, they'd have to breach through 3,600 to really feel the fear. Okay, don't forget that, because that's where people get, I want to sell some premium and get a little frustrated over here. Don't panic. We're not looking for volatility, not yet. We're just going to ping back and forth. And as such, we'll take advantage of that trade. Works for me. I have no qualms about saying we've done extremely well in the volatility we've been handed. Speaking of which, get your trade on each and every week here at TheoTrade. Well, we discuss this week's profits, losses and a couple of new trades. This week for me was, it was almost all about closing positions profitably. I really only opened kind of one new in terms of a real kind of core position. I really only opened one real core position. It had nothing to do with the holidays, just had to do with the, the eventuality of, and opportunity, if you will. So I'll just give you the lowdown here. I closed all options inventory on the S&P options and futures. If you take a look at what I term my TheoTheta portfolio, TheoTheta big boy, look at this. There's absolutely unequivocally nothing in the portfolio. People, that doesn't happen very often. I have nothing in my premium selling portfolio. How did it happen? Over the last few days, closed. Okay, the only one position I've opened here. I did open a position on, of course, December 20th. I'll discuss that position in a moment. That had to deal with Caterpillar, but you can see I closed a 5150 put. I closed a hedge, closed another 3150. Okay, 3150 put, closed another 3150 put, and then closed a hedge. The puts made a decent profit, but the hedge actually made a tremendous amount. So we took off a trade at what we term the inflection point. Okay, on top of that, I actually closed all my ZB positions. Okay, all I had left in ZB is 2 short calls, both of which were actually closed for over 50% gains. Then, okay, if I went over to the TheoTheta small portfolio, on the TheoTheta small portfolio over here in Tasty, you'll see absolutely nothing, which is awesome. If I type in /MES, okay, on these micros in here, what did I actually do in terms of my portfolio over there? Close the entire portfolio again profitably. All trades closed. All trades closed were closed for better than a, there we go, MES. Want to make sure I get all these positions in here. Okay, so that everybody can actually see them. Closed all positions inside of the portfolio for better than the 50% gain. So it's over. It's done with. We are out of the contest, including any SPY positions left in the Zaba portfolio were also closed profitably. All right, so onward and upward from there. So what am I left with? Again, very, very little. Like my inventory, I had no, I wasn't attempting to close most of the inventory before the end of the year, but S&P options and futures made money. The ZB calls that I was short, those made money, especially with some sell side activity, specifically inside of the bond product. Closed the inflection point spreads over in the TheoTheta small portfolio. And then I initiated a new position inside of Catapult. For those of you that have absolutely no idea what Catapult happens to be, we'll explain it. Okay, what Catapult broke down to is here's a trade on Caterpillar. By the way, Catapult and Caterpillar have nothing to do with one another. I just, on a Catapult strategy, happen to trade Caterpillar, just deciphering over there. But what did I do in CAT? I bought a number of out-of-the-money put spreads. Why? I just took a look at Caterpillar. This has been one of the outperformers, of course, of the year. So I went out, in this case, we're all the way out to the March 17th expiration. I purchased a 220, 210 spread. Did it a couple of times. That entire spread, though, okay, has been financed in the S&P options and futures. And this, again, this trade, the opening of that trade happens to be right here, the option on future, okay? I went out and actually sold on 12/20. I sold the 3,100 puts. Again, I sold the 3,100 puts all the way out in the APE expiration. So we can scroll out in here all the way out to the April expirations, open up every strike you got, look all the way down to the 3,100s. So what I in effect did is I financed the Caterpillar spreads via having sold the 3,100, okay, S&P options on futures. Of course, the S&P options and futures, okay, that would be construed as a naked short option. But the hedge happens to be the fact that if the marketplace tanks, Caterpillar probably tanks with it. I make money on Caterpillar long before I would ever lose anything in the S&P options and futures. The only thing that could really damage me on this Catapult trade would be an absolutely horrendous 20% plus crash from where we presently are in this marketplace. So that's it for Get Your Trade On. Again, this is a week where we just closed a tremendous amount of inventory, opened up a new Catapult spread. Last but definitely not least, as we do each and every week here at TheoTrade, we update you in the SPX, the mother of all products. As I said a number of times here on this weekend's update, the SPX really ended the week for the most part massively unchanged, but I do want to show you something because I found this just stellar. It really was stellar. The sell side activity on Thursday, it got violent, and I like a little violence inside of my trade. Got violent right to the penny. That's the lower edge of the expected move, and we bounced off of it. If you're not looking at expected move, you're not seeing what this marketplace is capable of doing. We just came off of a $87 expected move, and it's very apparent that we did every penny of that $87 move. Nevertheless, what are we expecting this next week of trade? I'll remind each and every one of you this next week of trade, Monday, the markets are closed. So 7 days out, what are we looking for? About a $71 expected move, which the volatility is not dissimilar, okay, to the week we just came off of. Again, we're going into a 4-day trading week. We're going to be at about a 71-point expected move. So hands and feet inside of the vehicle. Again, for holiday trade, okay, you wouldn't have anticipated 1.3 million contracts, but we got there. Okay, holiday or no holiday, markets are moving, people. Again, markets are moving. Very likely that we're headed back into the volatility hurt locker. Thanks, everybody, for joining us here at TheoTrade. Happy holidays. Have a great weekend, everybody. Bye-bye.